I have just a couple minutes after. We're going to go ahead and get started. And before we get started on the presentation, I just have a couple housekeeping things. First of all, you are all in listen only mode just to cut down on some of the background noise. I'm going to allow some time for questions at the end. Hopefully, we'll have time for questions. And I'll ask you to either put your questions in the chat box or you can raise your hand and I can unmute you. Okay. Second thing is that this training is going to be recorded and archived for the benefit of those who are not able to join us today. So I will be putting this out on the DARS YouTube channel after the meeting, and I will send you a link to it when I have it. You can, if you're certified through Cornell, you can use this training as part of your continuing education credits. Ray has already given permission for any trainings that I do to be used toward your continuing ed credits. Um, so just as a reminder, if you're certified through Cornell, you can log in those credits after the webinar today. Alrighty, and I wanted to do this webinar on SSI, SSDI, work incentives, and self-employment, because even if you've been a WISA that's been around for a long time, you're probably very familiar with the rules on how work rules and work incentives work when somebody's an employee. But I realized as I've gotten questions from a lot of you that I haven't focused probably as much on self-employment rules and how the self-employment rules are different with y'all than I should have. So I wanted to dedicate some time today to just focus on self-employment and how that differs from the rules in terms of how Social Security counts income and work incentives than you might be familiar with. As a reminder, as I'm going through this, if you get a referral from a VR counselor, and the VR goal when you get that work referral says that the client is thinking about working in self-employment, or if the client identifies a self-employment goal, keep in mind that the information that you put in your work role report should be reflective of some of the things that we talked today about in terms of how Social Security looks at income and work incentives. So if you know somebody has a self-employment goal and you're putting together a work report, I really would like all of you to focus on the work rules and the work incentives that we're going to be talking about today during this presentation, rather than just the standard format that you're familiar with. Okay. So just a couple announcements to get us started. And the first thing I want to do is talk a little bit about self-employment and how it works for SSI. And then we'll talk about SSDI in a little bit. I think you'll see that the self-employment and SSI rules are pretty straightforward. There are a lot of similarities in terms of how Social Security calculates the impact of wages on a check for self-employment, similar to the way that they do for self for individuals working for an employer, but with a couple differences. And you'll see what I mean as we go along. I have some examples. But the main difference is that when somebody's working in self-employment and is on SSI, rather than using the gross wages that a person receives in a month as they would if somebody's an employee, Social Security looks at the average monthly net earnings from self-employment. NESC or NESI is used to calculate the impact of wages on that SSI check during the month. Okay, so one of the biggest differences between an employee that's working for somebody else and a self-employed person is, rather than looking at the total amount of gross wages in a month that a person earns as they would for an employee, they're looking at the average NESI or NESC from self-employment that a client earns in a month. And we'll talk a little bit about how Social Security calculates that in just a minute. So the NESC or NESC is determined on a taxable year basis. So when somebody is on SSI and they first report that they're going to work to Social Security, Social Security is going to ask the client to estimate rather, how much in net earnings minus expenses that they expect to earn for the year. And Social Security is going to use that information from that estimate that the client provides to determine how that income is going to impact the SSI check every month. Okay. And this is a breakdown to how that works. The annual NESI is used to determine the monthly net earnings from self-employment. So they're going to take that estimate of what the client expects to earn for the year and divide it up within the 12 calendar months in the year. Okay. So that's always going to be true no matter how many months of the year that a client works. So even if they work, let's say 6 months out of the year, they might have a seasonable job, or they only work during the summer months, or they might not work for the whole year. Even if they don't work for the whole year, if somebody is self-employed and not SSI, Social Security is going to take the annual net earnings that the client reports to them and divide by 12. Okay. So that's true even if they don't work for the entire year, even if they do seasonal employment, or it could be a situation where the person stops working, they're still going to look at monthly earnings divided by 12 calendar months. Okay. So the monthly NESC is the starting point for the basics SSI countable income calculation. So just to to make it a little bit clearer, I put in an example here. So Ellen comes to see you in June, and she has recently opened a web design company and projects $8,000 a year in net profit. She knows that she has to report her income to SSI, but she has some questions about what to tell them, and she's not sure what to report because her actual profit is expected to vary from month to month. Up until now, she's been receiving the full benefit rate. So if for 2025, that's 967, assume no in-kind support or anything, she's getting the full amount. And she has some questions about how her projected net earnings are going to impact her monthly SSI check. So she has a couple questions. What's her countable monthly income going to be? How much of that income is going to count against the SSI check? Okay, assume that it's June now, so she has some questions about what she should have received between the months of January and May. And then she has some questions about how much she should be receiving now that is June to the end of the year. Okay, so those are the big questions the client has in this scenario. And our job as the benefits counselor is to kind of go through with her how Social Security is going to look at that income and how it's going to impact the monthly check. And I have an example on the next slide about how that works. Okay. So the first thing that the Social Security is going to do, again, like I said, they're going to ask the client to estimate their annual net earnings for the year. And I know that's very difficult for the client to be able to do. They're not going to be sure whether they are going to make a profit or not, but Social Security is going to ask them to come up with a figure just to base the SSI check on. And it can kind of be difficult in self-employment situations because if a client estimates earnings too high, then their SSI check is going to be going down more than it should be. If they estimate too low and they get more SSI than they should, they're probably going to face an overpayment. So this is very difficult. I always used to tell people that I work with that were self-employed, just estimate as close as you can because Social Security will adjust it later, and we'll talk about that in a minute. Okay. But the first thing that they're going to do in an example like this, if a client has, let's say they reported $8,000 in annual net profit, Social Security is going to take that annual projection and multiply that by 0.9235. Okay. That's the deduction that everybody on that is working in self-employment gets. So they're going to take that $8,000 that the client projects, multiply that by 0.9235. That leaves a remainder of $7,388. After deductions, that's the annual NESE that Social Security is going to use to determine what the SSI check is going to be every month. Okay. So then what they're going to do from there is take the annual NESE after the deduction, the $7,388, divide that by 12 months in the year. Remember what I said, it doesn't matter how many months the client works. When they're an SSI, Social Security is always going to look at earnings during the calendar year. That leaves $616. That's the monthly NESE. So what that means is with a projection of $8,000 for the year after deductions, Social Security is going to look at it as if the SSI recipient has 616 in countable earnings for the month. Okay. Now, the next step should look very familiar. It doesn't matter whether a person is self-employed or an employee. Once Social Security determines what that NESE is for the year and divides by 12 months, they're going to figure out the SSI check in the exact same way as they would if somebody was employed. So this formula should look familiar to everybody. What they're going to do is take the earned income, the NESE. In this case, we said it's $616 a month. The first $20 doesn't count as a general income exclusion. Everybody knows that. Then they take away $65 for the month for the earned income exclusion. Everybody's familiar with that. In this situation, she doesn't have any impairment-related work expenses. I just kept it simple, but keep in mind that if somebody's on SSI and they do have impairment-related work expenses, that would be taken off there. That leaves $531. And then, as you all know, Social Security only counts half of that. So we'll divide that in half. That leaves a remainder of $265.50. Okay. So very simply, what that means is the projected annual NESE is $8,000 for this example. After all the deductions, they multiply the $8,000 by that figure I just gave you, divide by 12 to figure out how much counts monthly, and then takes all the regular budget exclusions that we're familiar with off of that. So in this situation, the client reported an annual NESE of $8,000 after all deductions, after all the formulas are done. The countable earned income is $265.50. This should also look familiar too. Once Social Security determines what the monthly profit is from the business, after all deductions, they're going to subtract that from the base SSI rate of 967 minus 265.50 in monthly countable earned income. That leaves this client in this scenario with an SSI check of 701.50 for the month. Okay. So, like I said, once Social Security figures out what that annual NESE should be, they count the income in the same way as they would for an employee. There's really no difference. The only difference is not only do they look at net earnings from self-employment instead of gross, whereas if you have a client who's working for an employee, it's not unusual for them to send in pay stubs every month. Social Security will use that information to determine what the cash benefit is monthly. When somebody is self-employed, because obviously they don't have any pay stubs, they're not going to have any W-2s, they're going to use those annual projections to determine what the SSI check is monthly. Okay. So the adjusted SSI amount applies to all months of the year, regardless of when the person starts working. Okay. So in this situation, even though the client started working in June, because Social Security looks at income that she would have had during the whole calendar year, that means she's actually been overpaid since January. Okay. Because again, they're looking at the whole calendar year, not just when the person starts working, when they're self-employed. And I know that doesn't sound fair. It really isn't fair to the SSI recipient, but that's just the way that Social Security has the rules set up. So even though the client doesn't start working until June and she doesn't report that profit until June, Social Security is going to look at it as if she's been overpaid since the beginning of the year because they're always going to be looking at that 12-month calendar year. And in my opinion, that's kind of one of the disadvantages for folks who are an SSI, um, when they're self-employed versus an employee, because Social Security calculates the income a little bit differently. But that's just how it works in self-employment cases. Um, I have a couple of slides in here on 1619B and Medicaid works. I'm going to go through them briefly, but don't want to take a whole lot of time with it because the policy for 1619B and Medicaid works is the exact same regardless of whether somebody is an employee or a self-employed person. You all know the 1619B criteria and the work rules, and you're familiar with Medicaid works. So don't want to spend a whole lot of time on it, but I'll just go through it briefly. So again, 1619B eligibility policies are the same for self-employment as they would be for an employee working for an employer. The only difference is that, again, rather than looking at gross earnings for the month for 1619B, they're going to be looking at that NESI. As long as the countable NESI is under the state threshold, which I think in 2025 in Virginia, it's just about 59,000, they can be protected under 1619B. They have to need Medicaid in order to work. The individual has to have a disabling condition still per Social Security's rules, and they have to meet all other eligibility requirements. So, in other words, other than earnings, like they have to have their unearned income within in SSI limits, and they have to have received SSI in at least 1 month. They have to have received a cash benefit in 1 month. So again, the criteria for 1619B is the same, regardless of whether somebody is in self-employment or employed. Only difference is that they're going to be looking at those net earnings rather than gross. Okay, so if somebody's on self-employed and their cash benefit goes to zero, they would have the same Medicaid protections and the same cash benefit protections as an employee would. Medicaid works very much the same thing. DMAS is going to use the exact same countable income calculation for self-employment cases as Social Security would. Okay, so going back to our example, let's say our client who reported a net earnings from self-employment of $8,000 a year, DMAS is going to use that calculation to determine how much countable income that she has for Medicaid works monthly, and then apply all the standard SSI budget exclusions to that. So they would determine in this situation that the client had a monthly income about $257 in earnings. Okay, they're going to apply that same formula as Social Security would, just like DMAS would if somebody was an employee applying for Medicaid works. Okay, so really no difference. Individuals have to have accountable income of no more than $1,800 per month at the time they apply, non-exempt resources of $2,000 at application. So that doesn't include resources that would be exempt in like a trust or an ABLE account. DMAS, much like Social Security, is going to be looking at accountable like checking savings accounts, making sure that everything's under that $2,000. So as long as the client has uh, a projected profit that they're going to be earning in that business, as long as they have a disability and as long as they meet that initial eligibility criteria, they could be considered for enrollment in Medicaid works, just like an employee would. So there's really no difference there. Okay. Wanted to take a minute to talk about reporting when somebody's on SSI and what they're going to have to tell Social Security. I've kind of already gone through this already, but just to recap, again, the annual NESC projections reported to SSA at the start of each calendar year are used to calculate how much of the income is going to impact the client monthly, how much is going to count against that SSI check, how much SSI the person is going to be entitled to based on their projections. It's going to matter in terms of whether or not a person is going to be eligible for Medicaid in that month. If they still have a cash SSI benefit, like our client did in this example, obviously they're still going to be qualified for Medicaid as well. Or depending on what their earnings are, if the SSI zeroes out, they might need to request enrollment in 1619B to protect that Medicaid. Okay. Again, as I said, the Social Security Administration, when somebody first goes to work on self-employment, is going to ask the client to project what their earnings are going to be for the year. So the client should project as accurate as possible. I know that's very difficult, but projections lower than actual um, earnings can result in an overpayment of benefits because again, they're going to look at profit for the entire year or projections higher than actual results in an underpayment. So what Social Security is going to do is even though they're going to use the client's projected income to determine what the SSI check is going to be every month, when the client actually gets to the point where they're ready to file that tax return, the client should provide a copy of that tax return to Social Security, and Social Security will go back and retroactively adjust um, the um, the SSI check. So, for example, if somebody um, projects too high and their SSI check goes down, Social Security, once they have that tax return, can go back and issue an underpayment in benefits if um, if they didn't get enough during the calendar month. So it's better, in my opinion, to adjust higher than what their actual income is going to be, because even though their SSI might go down a little bit, they're much less likely to have to worry about overpayments when Social Security goes back and looks at the tax returns than they would be if they projected too low in those earnings. Just a note on resources, I don't have a slide on resources in here, and I probably should have put one in. But the resource rules for self-employed individuals who are on SSI are very similar to the resource rules for somebody who's an employee. There's still that $2,000 resource rule. If a client has like a business account that they have money in and they can withdraw money from that account, that could be considered accountable resource. Okay. So just because somebody has a business account does not mean that they're exempt from that resource rule. There are some exemptions for things like property. If somebody was using property to uh, run their business, and that could be not counted against the resource rule. Like, for example, say somebody had a patch of land that their house wasn't sitting on. Normally, that would count against the resource limit, maybe make them ineligible. But let's say they were a farmer and they said, well, I use this land that I own primarily for the purposes of growing and selling my crops. As long as it's for a property used for a business purpose, Social Security would not count that. It's called property essential to self-support. That applies when somebody's self-employed and non-SSI. If they allege that property or items they own is used in the operation of their business, Social Security would not count it as a resource. But if you're talking about money that they have in a business account, cash they have on hand, cash that they can withdraw from, just because it's in a business account again doesn't mean it doesn't count. So they need to report things like that as well. Um, able accounts. Able accounts it can be used by the self-employed individual as well. So if somebody has a business account and they think the resources are going to go over $2,000, one way potentially around that resource issue is to um, transfer that money into an ABLE account. Uh, they can contribute up to $19,000 this year. And again, just as an employee, money in that ABLE account would be exempt from the resource rule. So that could be a way around it if they were ABLE eligible. And while I'm thinking about it, right now, the age of onset for ABLE, as you probably know, is 26 or 26. That's going to be going up to 46 in the next year. That was a bill that was passed by Congress a few years ago. That's going to be taking effect next year. So instead of 26, people who had a disability up to 46 may be eligible for ABLE accounts starting next year. Okay. So that is a possibility for folks who are on a society that might have uh, what's the word? On a society might have concerns about concerns about resources rather. Okay. So that is it in a nutshell for SSI. Pretty straightforward. I can pause here for a minute uh, just to ask if there's any questions about anything that I just covered. If so, you can put them in the chat box.
Yeah, I was going to say, Mike, there's a few questions in the chat.
Okay. Yeah, let me just pull up the chat. 1 second. I have the transcript up on my screen too, so I'm kind of toggling back and forth here. Okay, yeah, okay. Andrew has a question. Let's see. Actually, there's a few. Are IRWs also applied like NESEs, like the total IRWs divided by 12? Yeah, they can take if somebody has a large expense, they can divide that up within the 12 calendar months. Yes. Andrew says our IRWs only applied in the month that they are incurred. Yeah, Andrew, if somebody has like an ongoing IRW, um, again, they can divide that up within the 12 months.
Wait, can I ask a question?
Of course.
Okay, so if someone incurred like a maybe a one-time or two-time IRWI when they were not working, right? When the business was not operating, and then the business resumed, but the IRWI did not resume. Would all the IRWI expenses be divided in 12, just like the income expenses, and then counteracted? Would it be done like that, or would the IRWI? Because I guess normally, if someone works, right, if an SSI recipient works, their IRWIs only count in the months that they work. Does that make sense? What I'm saying?
Right, it does. But with the rules for self-employment being different, and they're looking at income within 12 months, they should divide the IRWI within 12 months too. But I can go back and research the POMs on that, but I'm pretty sure that it works the same way as they would look at income is how they would look at IRWIs. Jennifer asks, will SSA send a notice about the overpayment right away or wait until the person has submitted their tax return, verifying the actual amount earned the following year? If the person doesn't have any income from SE work yet, they might not have funds to pay back an overpayment. Yeah, and Jennifer, they're not really going to know exactly uh, whether somebody's overpaid until they actually get a copy of the tax return and go back and adjust for overpayments or underpayments as necessary. Because again, they are going to just look at the the projections that the client reports when they first begin working to determine what's monthly. So yeah, I know that the rules really aren't fair, especially if the business is not making a profit or they didn't work the whole year. Having the funds to repay that is going to be very difficult. But in a situation like that, in SSI cases, they can still repay as low as $10 a month. So there are arrangements that somebody can work out with Social Security if they do have an overpayment. Um, Andrew says, I am a self-employed benefits counselor who receives SSI. This is my first year working, and Social Security told me that I would have to go through a review at the end of the year, or the estimated SCIE, the estimated NESC will be reconciled with the actual NESC. Can you talk about more about this review? Yeah, so Andrew, kind of goes back to what I said before. At the end of the year, they're probably going to ask you to uh, submit a copy of your tax returns, and then Social Security will go back and adjust your monthly SSI check as needed based on whether there are overpayments or underpayments. So that's kind of what that review is. Jennifer asks for resources. Can an ABLE account be used to save for estimated taxes on SC income? Yeah, there's not a whole lot of limitations in terms of what the ABLE account funds can be used for. So yeah, I would think that that was a possibility. How does debt cancellation income impact SSI benefits for self-employed contractors? What do you mean by cancellation income, Andrew?
So like I owed a credit card company, I don't know, like $2,800 a few years ago, and they sent me a form saying we've canceled the debt, which now constitutes income. So they sent me like a form that I had to file with my taxes, right? So I just did my taxes, and it shows, that I received other income, right? In addition to my self-employment income, there's the other income of the debt cancellation income. Does that make sense?
Okay, yeah, I'm with you. So what I would do there, when you submit your tax returns is also submit a statement explaining what happened and that's a canceled debt, not actual income from employment that you received. And Social Security can kind of figure out from there, whether or not that's going to impact, your monthly benefit amount. It's always going to be up to Social Security to determine how much the SSI check is going to be. So, report everything, explain what happened there, explain, where that debt cancellation came from, and then Social Security can kind of figure from there whether or not it's going to have any impact on your monthly benefit. Any other questions on SSI before we close the door and start talking about SSDI? SSDI is a little bit more complicated, and I have a little bit more slides. So um, if there's no more questions, we'll shut the door on SSI now and move on to DI. I'll give you another minute to type any questions while I get the DI presentation up.
Well, is there a policy for like debt cancellation income in general? I mean, I was looking at voiding, trying to discharge student loans in bankruptcy. That's more in the future, but is there a formal policy to deal like is debt cancellation income like real income, just like any other kind of income? I mean, it was on my taxes. Um,
Yeah, I would have to go to be honest with you. That's not something that I'm familiar with very much. So I would have to go back in the Palms and look at that, but I can do that and see if there's specific policy and how Social Security is going to look at that. When I send out the meeting recording, I'll also send any information that I can find in the Palms related to that, so y'all have it. This recording is going to go out to the whole group. So if I can find any actual policy on that, I will let you know and I'll send it along.
awesome. Thank you very much.
Yep, you're very welcome. Just give me 1 minute. I just need to get a drink of water. Okay, so going to kind of close the door on SSI now and talk about SSDI and self-employment. And as with SSI, you'll find that there are some similarities and some differences, whether you're talking about a person on SSDI working for an employee or as an employee rather, or for themselves as a self-employed person. So there's similarities, also differences. So we're just going to kind of go through how things are similar and how things are different in terms of work rules and work incentives. Oh, one last thing I wanted to mention about SSI before we move on is that it's not just IRWE that would apply. If somebody was on SSI, they can also use things like student earned income exclusion, if they're blind, blind work expenses, all the same SSI work incentives that would apply to an employee also apply to a self-employed person. Okay, so all those work incentives are available. I forgot to mention that it's not just IRB that they can use. Okay. So when you're looking at somebody who's on SSDI and self-employed, the only difference between SSI and SSDI is that Social Security is also going to look at that net earnings from self-employment or NESI when determining how much income counts against the SSDI check per month. Okay. So that's really the only difference between two benefits is that Social Security is looking at net earnings. For Social Security disability, though, the way they calculate earnings is going to be much different. So people who are on self-employed have a trial work period, just like anybody who's working as an employee would. And during the trial work period, Social Security will assess the NESI on a monthly basis, but they can also average if the beneficiary does not provide monthly records. So similar to the way they do it in SSI, where Social Security is going to ask the person to estimate what their profit's going to be. Social Security, when somebody is on SSDI and goes to work, Social Security is going to ask them for profit and loss statements, okay, to kind of determine whether or not the net earnings from that month count against the trial work period. Okay. If the person does not have any monthly records, if they don't keep accurate records or have those month profit and loss statements to provide Social Security when they report their work, Social Security can average that and divide it up in the number of months that the beneficiary worked. So where it's different from SSI, where I told you in SSI, they always go by the calendar month. They always divide by 12. For SSDI, they actually can average earnings based on the number of months that a client worked for the year. So they don't look at the whole year in SSDI cases, but rather they're concerned with the months that the client actually worked. Okay. No work incentives apply during the trial work period. So there are no IRBs, there are none of that. So there's no difference between that rule for self-employed people as there would be for an employee. People that are blind are subject to the same trial work period limit that people who are not blind are. There's no difference between wage employment and self-employment in terms of that for the trial work period. Um, they're gonna just it's the same. The difference is that when they look at whether or not a client is working over the trial work period limit, they're going to look at the gross receipts for the month. So what the person's reported as a gross receipt on their profit and loss statement, minus any allowable expenses. And we'll talk about what Social Security allows as an expense in a minute, multiplied by that 0.9235. That equals the NESE. So Social Security is going to multiply what the person has reported as their gross receipts, take away any expenses, and multiply by that same 0.9235 that they do if they run SSI. The same thing applies for SSDI. Okay, so it's actually going to be gross receipts minus expenses times the 9.235 to determine whether or not the client is over that trial work period limit or not. So that's another difference. So as you know, if somebody's an employee working for somebody else, Social Security is going to look at the gross income in a month to determine if a person's using a trial work period month. Whereas if they were self-employed, they're going to be looking at that net earnings from self-employment to determine if a trial work period month is used. Okay. Another difference is that if somebody is self-employed, trial work period months are used if the net earnings from self-employment for the month exceeds the trial work period amount. So, you know, the trial work period amount again is the same for a self-employment person as it would be for an employee. But the difference is that they can also consider that a client has used a trial work period month if they report that they worked more than 80 hours in the business. Okay. That doesn't matter. It doesn't matter if the business makes any money that month or has a loss. If the person says they've invested more than 80 hours per month in that business, if they're self-employed, Social Security can consider that a trial work period month, even if they don't make a profit in that month. Okay. So I always tell folks to track and document all hours worked as well as the net income for the month in each calendar month during that trial work period, because Social Security is going to use the income from that profit and loss statement to determine whether or not they have countable earnings above that trial work period limit or not. So same rules apply. If somebody's self-employed in that trial work period, there's no SGA, there's none of that. There's no work incentives used. They're going to be entitled to their benefit no matter what. So in that way, it's the same as an employee. The only difference is that they're looking at net earnings to compare to the trial work period limit amount, or whether they work more than 80 hours in the month or not. Okay, so that's kind of how the trial work period works if somebody's self-employed. So in order to keep track of whether a month is used, again, Social Security is going to use those profit and loss statements that a client provides to them. They're going to look at the beneficiary statement of hours worked. So again, they're going to ask the beneficiary, what have you earned in net profit this month? How many hours have you worked? And they can use a tax return only if the client does not keep monthly profit and loss statements. If the client's keeping monthly records, Social Security is going to go by those monthly records to determine trial work period usage. Okay. So when you're looking at self-employment and substantial gainful activity, so first thing that I want to point out is I don't think it's on the slide here, but the SGA figure, whether somebody's blind or disabled, is the exact same if they're self-employed as it would be for an employee. The only difference is, again, rather than looking at gross income as they would for an employee, they're going to be looking at net earnings to determine SGA. And we're going to talk about some of the deductions they allow in a couple minutes. But they use a couple different tests to determine whether a self-employed person is engaging in SGA or not. One is the countable income test. This applies to beneficiaries who have received benefits for at least 24 months. So you're working with somebody who's been on benefits for at least 2 years. This test always applies to Title II beneficiaries who are blind, but it doesn't apply if Social Security ceased benefits earlier in the EPE. So just as a client who's self-employed gets a trial work period, they would get an EPE just as a person working as an employee would, and the EPE works exactly the same. Starts, right after the ninth trial work period month, runs for 36 consecutive months. All that is exactly the same. If Social Security has ceased benefits during that EPE due to SGA, they're going to evaluate their work activity a little bit differently. And I'll talk about that in a minute, how that works. The other way that Social Security evaluates work activity is using a three-step test. This is used when somebody first applies for benefits. And as you know, whether or not somebody's an employee or self-employed, if they're working when they apply for benefits, part of that decision on whether or not they meet Social Security's definition of disability is going to be looking at work activity and whether the person has demonstrated an ability to perform substantial work. So the three-step test is going to be used when somebody first applies for benefits, and I'll go through what that test is in a minute, so y'all have that info. This also applies if you're working with a beneficiary who has not received benefits for 24 months. Maybe they've only been on benefits a year. Social Security is going to look at their ability to do SGA a little bit differently than they would if somebody's been on benefits for 24 months or more. Okay. They also use this test if benefits has been ceased during the EPE and during the initial reinstatement period for EXR cases. So the initial reinstatement period, if somebody's applied for EXR, is that 24-month period between getting back on benefits and going to work. So if somebody has received 24 payments under EXR, then they've served that initial reinstatement period. They get a whole brand new try work period, EPE, EXR period, the whole gamut of work incentives. But the three-step test is used if a person has been reinstated under EXR and hasn't received payments for 24 months yet. And again, I'll go through the differences of all the tests as we go along. So first thing, accountable income test. Again, this is going to apply to all beneficiaries who are blind and who are disabled and have been receiving benefits for at least 24 months. Did somebody have a question? If not, can you put yourself on mute, please? Just to kind of cut down on some of the background noise. Thanks. Okay. So Social Security will compare the monthly countable NESE to the SGA guideline. So they're going to take the average monthly NESE and the annual NESE is divided by the representative period. So again, only includes the months where the business was operational. So if somebody says my profit is, let's say, $8,000 for the year, but I only work 6 months, Social Security can average that out, $8,000 divided by 6. They're not going to look at the whole 12-month period as they would in an SSI case. If somebody's on DI and they say I have a seasonable job and I only work 6 months, then they're going to average it out during the period that the client worked. Okay, so they're going to look at monthly earnings representative of the period the client works. Okay. All work incentives apply. Again, this is after the try work period. They can use things like IRWEs, unpaid help, unincurred business expenses, unsuccessful work attempt. And I'll go through each of these in detail. But there are some specific work incentives that only apply to people who are self-employed on SSDI that aren't available to employees. We'll go through each one of those in a minute. Just a side note on the IRB though, if somebody's on SSDI or SSI for that matter, and they deduct the cost of something that could also be an IRB as a business expense on their tax return, they can't also claim that as an IRB with Social Security because they've already deducted that as a business expense with the IRS. So you can't double dip. A person on SSDI can use an IRB, but only if they have not already deducted that as a business expense. All right. But once the person completes that trial work period, all the work incentives come into play as they would for any other person. And I'm not going to talk about IRWI because you all know what that is. The criteria for what constitutes an IRWI is the exact same, whether or not somebody is self-employed or an employee. So I'm not gonna take the time to go there. So next thing I wanted to talk about was the three-step test, and I just need another drink of water. So the general criteria for evaluating work activity of self-employed individuals for SGA purposes consists of 3 tests. And again, this typically would be for somebody that has gone to work and not received payments for 24 months. Social Security will consider all of these tests before they can make a decision as to whether or not the person is doing SGA level work. Okay. If the countable income test applies, the 3 tests do not apply. So if somebody's been on benefits for more than 24 months, they're going to be looking at countable income. Less than, then they're going to be using this 3-step test. And I'm going to go through what each one of these means. Test 1, significant services and substantial income. Test 2, comparability of work activity. Test 3, worth of work. And let's kind of break those down and go through what each one of them means. So test 1 is significant services in SGA. So significant services applies to anybody who's a sole proprietor. So they're just running the business as their own. Social Security is considering self proprietors because they're running the business themselves to be investing significant time in building that business and running it because they have nobody working with them. If they're a self-employed person, maybe they have a business partner, they would be considered putting significant effort into operation of the business if the beneficiary contributes more than total half the time of the month in operating the business, or they say, I'm spending at least 45 hours per month managing the business. Social Security is going to kind of look at that as a significant effort into running that business. And then they're going to look at whether or not the business is generating a substantial income. So they're going to look at whether countable income after all deductions, and we're going to be talking a little bit in a minute about what work incentives apply in self-employment cases. But they're going to be looking at whether countable income exceeds SGA or below SGA, just as they would in a case where somebody was an employee. But they're also going to be looking at whether or not the income that the person is making is comparable to the income that they had coming in before they became disabled. Or if they're making as much money as somebody without a disability comparable within the community. So even if somebody is not earning a profit that's above SGA, if they're self-employed on SSDI, if the money that they're making is comparable to what they were making before they became disabled, Social Security might find that they're able to do substantial work and it could impact the benefit. Okay. But again, it doesn't stop there. There are other tests that Social Security looks at, and all these tests have to be met for them to make an SGA finding. So let's look at the next one. Test 2, Social Security is going to look at comparability of work. And so what that means is that they're going to look at the work efforts of the beneficiary. They're going to look at their statements of how many hours of a month they invest in building that business. And they're going to compare the work effort of a beneficiary of that of others in the community without disabilities. So basically what that means is the person with the disability receiving that SSDI check capable of working or investing as many hours into building their business as somebody without a disability in that community? They're going to look at how much time a person invests in their business per month and what sort of job duties or responsibilities they have in that job. Okay. So if Social Security finds that work is comparable, if they're investing the same hours that a person in their community without a disability is doing, and they're capable of doing the same type of work, Social Security might find that that person who's self-employed can do SGA level work, even if their business is making little money or operating at a loss. Because as you remember, even if somebody's employed, yes, that 1620 figure in 2025 does matter. They are going to be looking at earnings above that, a pattern of earnings above that. But SGA is more than just a number. It's a decision that Social Security makes to show whether or not a person can sustain that level of earnings based on their skills and abilities and how much they're able to work. Okay. So for self-employed people, it's the same thing. Even if they're not making above SGA necessarily, if they show that they're capable of investing substantial time in a business and at work, that could result in a finding of SGA, even if they're not making over the SGA amount. So SGA is always more than a number. Okay. Test three, they're going to look at worth of work, and it evaluates whether the work activity is worth more than SGA, even if it's not comparable to others. Again, they're going to look at how many hours a month that a person puts in. They're going to look at work activity is more than SGA, then it's considered substantial regardless of accountable income. Again, if a person says, and this is just an example, okay, but if a person says, I have a disability, I have limitations in the amount of work or the work that I can do, but yet they're spending, let's say 100 hours a month working, investing that time building up that business, that could lead Social Security to a finding that maybe they are capable of doing substantial work because, on one hand, they're saying, well, I have all these limitations, my disability limits my ability to work, but yet they're working 100 hours a month. That could um, cause Social Security to say, well, wait a minute, is their disability really um, substantial enough to prevent them from investing all these hours into building this business? So, again, it's not just how much a month that the client makes that Social Security is looking at. They're looking at how much time the person's investing in the business and what they're capable of doing at that job. Okay. So when making an SGA determination, Social Security is going to look not just at the number again, but the value of the work effort is what they're looking at. Social Security is looking for a consistent pattern of work behavior. So that might mean that a client says, I've been working at my job for 6 months. I've been putting in 100 hours a month. That's a consistent pattern of work behavior that might show that they're capable of working at a substantial level, even if they're not earning over the substantial gainful activity figure yet. But Social Security is going to um, use various work incentives to determine whether or not that work is a SGA. Okay, just like they would for somebody who's an employee not working for themselves, but working for somebody else. Just as those people would be able to use things like IRWs and subsidies to reduce those countable earnings below SGA, self-employed people have work incentives available to them too. But they have a couple different ones that an employee doesn't have. Um, they can use unsuccessful work attempt, and I didn't put a slide on this, but just as an employee can use an unsuccessful work attempt, a self-employed person can too. What that means is that person has gone to work, receiving benefits, has gone to work, has tried to do work at a substantial level and can't sustain that. Um, work for 6 months or less. So let's say, for example, somebody goes to work for 4 months. They're making over SGA. Their symptoms, their disability worsen. They can't work anymore. They reduce their hours. Social Security will say, well, you tried work at a substantial level. Your earnings are clearly below SGA now. That's an unsuccessful work attempt. And they won't consider um, the earnings for those months in determining whether or not somebody's SGA. So they're looking at whether a person can sustain SGA level work. And if they have a pattern of starting and stopping work because of their disability, that could be considered an unsuccessful work attempt and show that they're not able to sustain that SGA level work. Okay, so that's what unsuccessful work attempt means. That's available to people who are on uh, SSDI whether they're an employee or working for somebody else or self-employed. They'll use income averaging, which I'll talk about in a minute. IRWIs would apply to the SGA determination just like they would for a employee. Self-employed people are able to use those IRWIs again as long as they haven't deducted that expense on their tax return with the IRS. They can use an IRWI, and Social Security will use that IRWI in terms of making a decision. And again, IRWIs for self-employed people work the exact same way as they do for employees. So I'm not going to go through that. Last two on this slide are specific to self-employed individuals. Unincurred business expenses and unpaid help. And I'm going to go through what each one of those means in just a minute. So next thing I want to talk about is income averaging. This is one of the tools that Social Security will use when a client's self-employed to determine whether or not the income that they report from self-employment is SGA or not. During the trial work period, if somebody's in that, the actual NESC is assessed monthly, if at all possible. So again, they're going to look at information provided by that beneficiary on those profit and loss statements. If the client has not kept accurate records, Social Security can actually average income to determine whether or not a person's using that trial work period or not. Averaging can be done over the period worked. So again, if somebody says, I only worked for 6 months, they'll take the profit that a person projects, divide by 6 to determine what's countable monthly during that trial work period. But averaging can never occur across calendar years because averaging can't be done if the SGA level changes. So it's not a situation where they can average for, let's say, 2 years in a row. It has to be work that's done in this year. Okay. Um, Again, there's a slide on IRWI here, but I'm not going to go through it because it's exactly the same as it would be for an employee. But again, just keep in mind what I said is that IRWIs can only be deducted in self-employment cases if they have not already been deducted on a profit and loss statement and on the tax return with the IRS, because that's, again, double dipping. Okay. So let's take an example of what's a business expense versus what an IRWI looks like. Okay, so I've given you an example here to kind of show whether or not a client can use a business expense or an IRWI. So Kate runs a virtual secretary company that generates, let's say, $2,000 in gross income in May. And she schedules an appointment with you because she's not sure how to track those expenses or what to report to Social Security in terms of IRWIs. Okay, so she pays $250 a month to a driver to take her to appointments with clients. So as part of her business, she has to meet with these clients and she can't drive, so she pays a driver the $250 a month to take her back and forth. Okay. And then she also has a physical therapist 3 times a month to assist her with her mobility issues, and she pays a copay for these appointments, $25 each. So she's got a copay of $75 a month for her physical therapy appointments. Okay. Transportation is something that could be a business expense. Um, that's something that can be deducted with the IRS. It could qualify as both an IRWI or a business expense because in this case, the transportation is related to her disability. Claiming it as a business expense would allow her to deduct it before net profit is calculated, though. So it could actually reduce her tax liability. And because of that, because she might have to pay less taxes at the end of the year, deducting that as a business expense could probably be more advantageous for her than it would be to just claim it for the purposes of SSDI. Okay. The physical therapist should be claimed as an IRWI though, because that's not something that's deductible with the IRS, most likely. That's not a business expense. That would be an out-of-pocket personal expense related to her disability. So that would likely be an early. So she could have $250 a month that she deducts as a business expense for that transportation, plus $75 a month in that early, okay, for the therapist. That's the difference. If it's disability related, work related, needed to work, she pays for, it could be claimed as an early. If it's an expense that could be deducted as a business expense with the IRS, then it should be deducted that way. Okay. So just to take a couple minutes to talk about the two specific work incentives for SSDI folks who are self-employed: unincurred business expenses and unpaid help. I want to kind of go through what they are and give you an example of how they might work. Okay. Expenses, unincurred business expenses are expenses paid by another agency or individual. So not necessarily the person operating the business, but um, another person or individual that are helping them with business expenses they need to run their business. Okay. So just using VR as an example, say somebody had come to DARS and their goal is to work in self-employment and they need a computer and a phone and they need internet to operate the business. And as part of their employment plan, VR says, yeah, we will help you purchase the computer and we'll pay your monthly phone and internet bill for a certain period of time. That's an expense example of a business expense that maybe the individual didn't incur, but they're receiving help with. Okay. So Social Security is going to look at that because even though they need this equipment to operate the business, even though that equipment is helping the client generate income that could be considered as part of the SGA determination, without the contributions of that agency, in this case, without VR helping her pay for those expenses, she might not be able to earn the profit that she's earning. So Social Security is going to take into consideration the help that she got from VR to pay for these expenses that she needs to operate the business. Unincurred business expenses, then, when Social Security is looking at how much of those net earnings to count every month, are deducted from countable earned income. I'll give you an example here. Okay. So there's a couple ways that Social Security looks at them. They can either take the actual value of what the business expense is, so the actual expense amount deducted in the month that the expense was paid for. That can be used for ongoing monthly expenses like the phone and internet bills. Or if there are big ticket items, so large purchase items that VR helps pay for, may be deducted by spreading the cost over several years. Okay. The cost is divided by the number of months of useful life, similar to depreciation. So just like when somebody buys a new car and they drive the car off the lot, the value automatically goes down. The value of these expenses that VR helps pay for is also going to go down. And I'll give you an example of that in a minute, just so you can see how it works. Okay. Or they're going to look at fair value. If there's no actual price tag, they can also be used for expenses not specifically incurred, such as free rent. So Social Security determines the market value of the expense and deducts that amount each month. Now, that's an example. I would find it hard to believe that somebody would um, be able to operate their business without having to pay rent. But if it's an example of a family member or friend helping them pay for that expense, Social Security could assign a value to that and determine that as a business expense also. Here's an example of how unincurred business expense works, and this is how it would work in terms of an SGA determination. Okay. So Kate schedules another appointment with you in January. Let's say she's in her EPE, she's in her 12th month. Her business is generating an average of monthly NESC of $2,200 a month. Okay. So at first glance, she's in her EPE. Her monthly NESC after deductions is 2,200. looks like she's above SGA, right? And she wouldn't be entitled to a benefit check that month, okay? But she's also working with VR, and VR helped her with the purchase of a copier for her business. And VR paid $6,000 a month for that copier, okay? And let's say the useful life of that copier is 24 months before the value of the copier starts going down, okay? So VR has paid out of pocket $6,000 a month for this copier. They've also agreed to pay her phone bill for $75 for 3 months. So January, February, March, and when she's operating this business, VR is going to pay that phone bill for $75 a month for 3 months. Okay, so could these VR purchases be applied as unincurred business expenses? And if so, how would Social Security determine how much to deduct? Well, they could, right? Because as I talked about, these are expenses that are needed in order for her to operate her business. She's not paying for them out of pocket, but with the help of VR, VR is paying for these expenses, and based on what they're putting out, is going to help her generate a profit. So Social Security is not going to count all of her net earnings from self-employment because they're also going to look at any deductions that she has. Okay. So here's an example. Both purchases can be applied as an unincurred business expense or unincurred work expense. The phone bill that VR is going to pay for, $75 a month between January and March, counts as an expense because that's an expense that VR is incurring on her behalf. Also, rather than taking the total value of the copier, Social Security is going to look at the total value of what VR put out, divide that by 24 months. That's the useful life of the copier, and that leaves $250 a month. Okay. So those large purchase items, like we talked about, like in IRWI before, if there's a large purchase item, Social Security can take the value of that and divide it up between several months, or in this case, a few years, to determine how much is deductible as an expense monthly. So in this case, we're going to say that the value of the copier is worth $250 a month. So let's look at the income calculation again now that she has these unincurred business expenses. Before, we said that the average NSC for this client in this case is $2,200 a month. Again, looks like she's in her EPE. On paper, it looks like she's earning over SGA. Normally, that would be a cessation, but she does have these business expenses. So let's take a look at them. From that, Social Security will deduct $75 in medical expenses for the IRWI. Remember, we said that she had those co-pays for physical therapy that she paid for. So right off the bat, that's $75 in IRWIs that are not counted in terms of SGA. She also has $75 for the phone bill for January, February, and March that Social Security is not going to count because that's an expense that VR incurred. And they're going to also deduct $250 from her countable earnings because that's the value of the copier that they assigned to it. Okay. So countable NESC is $1,800 a month for January and March, and $1,875 for the remainder of the year. That's after the deductions for all these expenses. Okay. So you say, well, wait a minute. Even after deductions for unincurred business expenses, her earnings are still above SGA. How does that help her? Well, let's take a look at it on the next slide because that's not the only work incentive that she can use. I'll give you an example of another one that can be used to reduce those countable earnings. But yeah, in a normal case, if there were no other work incentives, the earnings are still over SGA, probably wouldn't be entitled to a benefit check that month. But let's look at another one that self-employed people and SSDI can use called unpaid help. This is the reasonable monetary value of any significant amount of unpaid help for business activities furnished by a spouse, children, or others is deducted from net income. Okay, so let's say a client is operating a business and they have a parent, a spouse, a friend contributing their time to helping the client run that business, and they're not receiving any payment for it. The spouse, the friend, the family member is not receiving any payment for helping them operate that business. They're doing it basically volunteer. In estimating the value of that help, Social Security is not going to count certain wages. Okay, I'll give you an example of how that works in a minute. This is an example of how unpaid help works. So let's go back to the example of Kate. Okay, after all the deductions for unincurred business expenses, her net earnings are still about $1,800 a month. But her mother is providing bookkeeping services for her company at no charge. Okay, so mom's working for her volunteer as a bookkeeper and not receiving any money for that. Okay. Her mother is a professional bookkeeper as her occupation and charges all of her other clients $22 an hour. So even though she's a bookkeeper, she charges $22 an hour because Kate's her daughter. She's not paying, not charging her for that. Okay. Mom spends about 15 hours a month doing all of her books. If the mom were to keep a log of how many hours that she worked in the month, that log could be submitted to Social Security as a documentation of unpaid help. Okay. So what Social Security is going to do is look at the $22 an hour that the mom would normally charge another client, multiplied by the 15 hours a week that mom works in the business for free. That's $330 per month that would not count in terms of determining Kate's wages for SGA. So they're going to look at hourly rate that she would normally charge times the number of hours a month that she works for free. That's how they come up with the 330. Okay. Now let's take another look at an example of NESC now that unpaid help is factored in. Okay. So she's got 1875 in NESC before the unpaid help. Okay. Profit would normally be more than SGA and check would cease without any other deductions. But because she has that unpaid help, it's going to reduce the amount of money that Social Security counts. So let's go back to the beginning. She was making $2,200 a month in net earnings from self-employment. Again, Social Security is not going to count that $75 in IRWI that she pays for physical therapy copays. They're not going to count $250 a month in that unincurred business expense for the copier that VR is paying for. They're also not going to count $330 in unpaid help because that's the value that they placed on mom's time for working in that business that mom wasn't getting paid for. And they realized that sometimes without the value of that help from family members and friends, that a client wouldn't fully be able to earn maybe what it looks like they're earning on paper without the help of an outside source. Okay. So 2,200 minus 75 for the IRWI, minus 250 for the unincurred business expense for the copier, minus 330 in unpaid help, brings her countable earnings down to $1,545 a month. Okay. Obviously, that's less than SGA. So even though it looks like on paper she may be earning more than SGA after you take off the IRWIs and other applicable work incentives, her countable earnings are less than SGA, and she's going to be entitled to a benefit check for that month. Okay, so that's the big difference of how work incentives can come into play when somebody's self-employed to make the difference as to whether or not she would get a check for that month. Because without any of those work incentives, she wouldn't. Once they look at all the deductions that she's allowed to take off, then her work can be considered under SGA and she would be entitled to her whole benefit check for that month. Okay. Now, if somebody's on Title II and they report their earnings, again, they're going to want to start keeping track of their monthly profit and loss statements, bring those to Social Security. Social Security is most likely going to initiate a work activity report based on the um, uh, report that they started work to track things like trial work period use. And then on that work activity report is going to be places for them to also document things like unpaid help that they might get from an outside source from VR, or unpaid help from a family member or friend. That would all be documented on a work activity report that Social Security is going to initiate when they report that they're working. And Social Security is going to use the information on that report to determine whether or not the work is SGA. Okay. Now, I know I kind of went through that PowerPoint pretty fast because there were a lot of slides and we're kind of short on time. I wanted to leave a few minutes for questions at the end. So let me just um, go back through the chat and we'll read some of these off, okay? Um, okay, Renee asks, I have an SSDI client who has a regular part-time job, but is also looking to, I think it says publish the book as well. Publisher usually pays a big payment at once or asks for a payment for editing up front. For the big income payment, can they put that into an ABLE account? But what if they needed to pull the money out of the ABLE account to pay for an editing fee? Is that a disability-related work expense? And can the IRB be divided by 12? So they can put money into an ABLE account, Renee, and I don't see any issue with them if they're an SSDI taking money out of the ABLE account to pay for that. Um, Again, there are no resource limits for SSDI, and money in an ABLE account would be exempt anyway. I don't think that paying for editing could be considered an IRWI just because it would be a stretch to show that's how that's disability related. So I don't think that that would work. Um, you have to show that IRWIs are related to the disability and how that allows the client to work. I don't think that that would be an expense that would be applicable. But yeah, I don't see any issue with using money in an ABLE account to pay for a service like that. It's absolutely fine. Um, Jennifer asks, is SSA looking at income on a cash or accrual basis? I may work 20 hours in May, but not get paid for that work until June. For taxes, people may be using cash accounting when they get paid, not from when they perform the work. Usually for SSDI purposes, they are looking at uh they are going to be looking at monthly rather than dividing it up within 12 months. They're going to be dividing up the profit within the number of months that a person works. So it's more of a monthly income for SSDI rather than an annual one for SSI.
And Mike, I can explain that question a bit more. I'm thinking of people that maybe are providing services as a self-employed person. So
Right.
let's say you do work for someone, but then you invoice them and you don't get paid until a month later. When Social Security is doing things like the trial work period, you're saying they're tracking at how many hours you worked, but also how much money you brought in. So I guess I had a question of like what you've put on your taxes might not align with the hours you work. So for example, if I performed work in December, but I didn't get paid until January, my 1099 isn't going to show that work from January, right? Because from that company's perspective, they didn't pay me for it until the next year. So I guess I
Right.
was just trying to figure out how people need to track things. If they need, if we're ultimately turning in these tax returns to Social Security, there might be a misalignment if we're trying to report like, well, I earned this in this month, but I didn't actually get paid in a different month. Does that make sense?
Yeah, I got you. I got you. That does make sense. And I think for SSDI purposes, because they're looking at monthly like profit and loss, if you do work in one month and don't get paid into another, it would be applicable in the month that you actually received the payment, not in the month you worked necessarily, unless, in that month you worked over the 80 hours, that could be considered a trial work period month. But really they're looking at money in the month that you earn it and over the period that you say you worked for the year.
Okay, so that would be like different from wages where like you might have earned it in one month and got paid in the next month, but they would count it in the month you earned it for wage work. Just trying
Right,
to
yeah,
clarify. Yeah.
yes. Yeah, self-employment is just a little bit differently in how they count it.
Yeah, that's why I just wanted to
Mhm.
clarify. Okay, that's helpful.
Okay.
And then the other question is mine too. I guess I had a question like on slide 9 for test 1. So you said if someone's a sole proprietorship, they're automatically assumed that they're doing substantial work. But I guess my question is like, what if they're getting a lot of unpaid help? Are they still
Uh-huh.
going to be automatically assumed under that test that they are doing substantial work?
Yeah, not substantial work necessarily, but putting substantial effort into the business. Um, they are going to look at things like unpaid help and unincurred business expenses as part of making the SGA determination. So that is going to be a factor, but they are going to look at how many hours a person puts in and what kind of work they're doing. That makes sense.
Yeah, I guess I was just trying to figure out where the unpaid help sort of came in on that because I was like, I can see definitely a few clients I've worked with that are sole proprietorships, but really they're getting a lot of support from parents and things like that.
Right. So yeah, generally unpaid help or any other work incentive would apply once the trial work period is over. Um, just like as it would for an employee when, if you're using like early or subsidy, those don't apply until after trial work. Same thing in the self-employment case. Once the trial work period is over, then they would be looking at like business expenses and unpaid help and all that other stuff as part of that SGA decision. Okay. And we are just about at 11:30. We have a couple more minutes. I'll give you a few more minutes to type your questions, or if you want to unmute yourself if you have a question, that's fine. I also wanted to say one thing before I forget this. If you've been through VCU's self-employment course, some of this material might have looked familiar. I did use their slides as a basis for mine with their permission. I know a lot of the um, instructors over there because I've been through the VCU course before and they gave me permission to use their slides. I just updated them to make them a little bit more current, but just wanted to give credit where credit was due, that they did put together the original presentation. Just wanted to throw that out there before I forgot. Um, any other last questions, concerns, comments?
Mike, this is
I know,
Beth Martin.
yeah, go ahead,
Um,
Beth.
I just wanted to go back to Jennifer's question. So, what if the help that somebody is receiving is not necessarily like business help, like more standard business help, but just like general support with, I don't know, activities of daily living and, the support that parents a lot of times may be providing, but wouldn't necessarily be considered like business type of help. How would that be counted?
Well, I would make the argument that without that help, like if somebody had a parent who is assisting them with bathing, dressing, showering, getting going in the morning, without that help, they wouldn't even be able to work. That would be an argument for unpaid help as well. I mean, it doesn't necessarily have to be business related. That was an example, but I would make the argument that, hey, without these services, you know, Johnny wouldn't even be able to get up and go to work in the morning. So I think that's all relevant.
Okay, that's great. Thank you.
Yeah. Now, if it's an example of, the service being paid for by like Medicaid or something like that, that could be different because Social Security will say, yeah, but, they have home care through Medicaid and, blah, blah, blah. But if it's a example of a family member providing that service, I think that would definitely fit into the definition. I'll give you all a couple more minutes just in case you're typing or if you have any other questions. I know that this is a lot. I threw a lot of information at you today. Um, but this is a webinar that I've been wanting to do for a while, and I hope it kind of clarifies things in terms of how things differ for employees versus self-employed. And again, just keep in mind when you're putting together your work reports that if a client has a VR goal that the counselor's given you, or if the client identifies, hey, I'm looking at maybe working for myself and I have some self-employment questions, you want to base your explanations in your report based on um, the self-employment work rules and work incentives more than you would for an employee necessarily. You always want to make sure that the information in the report is specific to the client's VR goal. Okay. Um, so we are just about out of time, but as always, if you have any other questions that come up, you can call me, email me. I'm around anytime. Um, feel free to reach out. Thank you for your time, attendance, and participation today. Greatly appreciated, and I hope to talk to you soon. Take care, everybody. Thanks.